Hello, everyone. This is Chris Verrone, head of technical and macro research for Strategas, the investment strategy arm of Baird. As always, it is a pleasure to get to spend some time with you and share our view on the markets. I want to highlight a few quick topics in today's video. I'll touch on both our base case as well as what worries us here. I also want to share a few things you may not know but probably should. And then lastly, we'll also address our current sector rankings. And I've brought along a few charts to help us do just that. But where I want to begin is really highlighting what we're thinking here. And as far as our market call goes, we still believe the trend of this market is up, but I want to be aware that under the surface, momentum has actually started to soften and we've seen the market bifurcate. Maybe said another way, since the last time we checked in a couple months ago, participation has gotten a little bit more narrow. I don't think that's fatal, but it may be frustrating. And I think the market under the surface over the last 6, 7, 8 weeks has certainly been more of the frustrating tone. What do we feel strongest about? We feel strongly that the leadership we're getting from the energy stocks is going to prove durable here. And we like the idea that oil will continue to surprise on the upside. Frankly, we wonder how long can oil and energy go up without it impacting consumer stocks? And we have started to see what I would describe some modest weakness emerge with some of the consumer names. I think that bears watching. What has surprised us over the last several months? I'm a little surprised that you've had all this speculative weakness. And by that I mean the IPO index is down 20 or 30%. The SPACs are down 20 or 30%. We've seen things like Bitcoin go down by a similar margin, and that has not bled into the broader market. I think that bears watching as we move through summer. What worries us? We're a little uncomfortable that bond yields have gone 175 back to roughly 145 on the 10-year yield. Our base case or our best guess is that the cycle high in bond yields is not in yet, but we have to be aware that the market seems to be challenging that view over the last number of weeks. I think ultimately, if bond yields were going a lot lower, leadership would look different than it does presently. We'll talk a little bit about that in a few minutes. What are a few things you might not know, but I think you should? One of our favorite facts is of the 19 sell-side firms and banks that forecast energy prices, just one firm has an oil forecast above $70 for the end of the year. The problem is crude's already above 70. So we still think we need to see the street move a lot of the forecasts to the right side of the bell curve. And one other thing you might not know but probably should, we hosted a dinner for clients about 2 or 3 weeks ago in Dallas, Texas. We had 22 people around the table. We had everyone share their year-end S&P target. I was just a little bit surprised that the lowest target among the group was 4,100. It's always surprising when you have a big group and you do a survey and there's not one outlier or not one bear. I think it speaks to the idea that the sentiment could be a risk as we move through summer. Where are we out of consensus? A couple groups in our work that we think are out of consensus. As we talked about, we think the energy leadership is durable. That is not a consensus view. We think global pharmaceutical stocks are getting better. I think that view is unique to our firm. And we think the defense contractors are starting to reemerge as leadership after a difficult last several years. And then lastly, where are we part of the consensus? Everyone we know, and ourselves included, are dollar bears. And I don't mind being part of the consensus, but I have to be aware of when I am. And we always have to be on guard for competing messages when that's the case. So a couple charts here that I want to show you. This is the NASDAQ 100. So the 100 largest tech and growth stocks made a new high this week, but I want to be a little bit mindful that under the surface, it's less pronounced. Only about 52% of the stocks in the NASDAQ are above their 50-day moving average. So this new high in price is a little less pronounced under the surface. Another thing that I want to be aware of, despite a new S&P high this week, we actually got an expansion in the number of names making a 1-month low. Now, typically when you get spikes in new lows, it can mark an oversold condition. You typically get a bounce. But I just want to be aware, again, another example of where there's been some modest deterioration under the surface. We've seen it with financials as well. You actually got a surge over the last several days in the percent of financial stocks making a 1-month low. The good news about this data set is it can be contrarian. When you get these big spikes in new lows, it's often a signal that the sector or the group is washed out and you're getting closer to some type of a tradable bottom. I'm not quite sure we're there yet with financials, but I do think we're generally in the ballpark. One thing we want to be mindful of, if you look at market seasonality, as you get to about July, the calendar starts to weaken. So what I'm showing you here are forward 3-month returns that we've just grouped by the historical average in each month. So when you tend to get to July, that is when the return profile over the next 3 months does start to suffer. I just want to be a little bit aware of that going forward. Lastly, just very quick, looking at some of our sector rankings. These are our large cap sector rankings. Energy and financials remain 1 and 2 at the top of this list. I do find it compelling that both staples and utilities remain at the bottom of our rankings. If bond yields were in fact going a lot lower from here, we would expect groups like staples and utilities to be stronger, and that just hasn't been the case. These defensive groups have offered no relative leadership over the last several months. With respect to energy, what I'm showing you here is the energy sector relative to the S&P over the last 15 years. This outperformance we've seen from energy over the last number of months is as good as anything we've seen in 13, 14, 15 years. Certainly better than any of the failed rallies over the last decade. We think that's a very, very potent signal. When you get these momentum surges, it can often precede a trend change. And we do think energy has changed trend. We do think ultimately energy stocks are likely to go higher from here. And then lastly, as we mentioned in our sector rankings, the consumer staples remain at the bottom of our list. This is the S&P consumer staples sector relative to the S&P. So new lows here this week, inconsistent with bond yields going a lot lower. Typically, staples outperform when yields go lower, and that just hasn't happened here yet. So we're looking to the equity market for signals on yields. We still think ultimately it points to higher bond yields from here. That's what we have today. As always, thanks for listening in, and this is Chris Verrone signing off. Take care.